Climate change is no longer a distant threat, it is a present danger. The insurance industry, with its unique role in assessing and managing risk, is acutely aware of this reality. Insurers are on the front lines, witnessing firsthand the increasing frequency and severity of extreme weather events. From devastating floods to raging wildfires, the financial toll of climate change is mounting. The insurance industry faces a critical choice. It can continue with a business-as-usual approach, clinging to outdated models and ignoring the writing on the wall, or it can choose a different path, one that acknowledges the urgency of the climate crisis and embraces transparency and proactive risk management. This is not just about protecting profits, it is about safeguarding the stability of the global economy and the well-being of communities worldwide. The insurance industry has a moral imperative to lead on climate action, and the time for hesitation is over. The future demands bold action, and the world is watching. In a world grappling with the complexities of climate change, the Task Force on Climate-Related Financial Disclosures, or TCFD, stands as a beacon of clarity. Established by the Financial Stability Board, the TCFD provides a comprehensive framework for companies to disclose their climate-related risks and opportunities. The TCFD's strength lies in its four core pillars: governance, strategy, risk management, and metrics and targets. These pillars provide a structured approach for companies to assess their climate resilience and communicate their findings to investors and the public. Governance focuses on the company's leadership and oversight of climate-related issues. Strategy examines the actual and potential impacts of climate change on the business. Risk management delves into how the company identifies, assesses, and manages climate-related risks. Finally, metrics and targets provide a measurable way to track progress and demonstrate accountability. The TCFD framework is not a one-size-fits-all solution, but rather a flexible and adaptable set of guidelines. It empowers companies to tailor their disclosures to their specific circumstances while adhering to a common set of principles. This comparability is crucial for investors and stakeholders who need clear and consistent information to make informed decisions. The insurance industry is built on a foundation of risk assessment. For centuries, insurers have relied on historical data and sophisticated models to price risk and ensure their own solvency. However, climate change is disrupting these traditional methods, introducing a level of uncertainty that is unprecedented in modern times. The increasing frequency and intensity of extreme weather events are challenging the very core of insurance underwriting. Floods, hurricanes, wildfires. These are no longer isolated incidents, they are becoming the new normal. As a result, insurers are facing a surge in claims, putting pressure on their balance sheets and forcing them to re-evaluate their risk exposure. Property and casualty insurers are particularly vulnerable. Coastal properties are increasingly at risk from rising sea levels and storm surges, making them increasingly expensive or even impossible to insure. Inland areas are not immune either, as extreme rainfall and prolonged droughts contribute to more frequent and severe flooding and wildfires. The agricultural sector is also facing significant challenges. Changing weather patterns are disrupting growing seasons and increasing the volatility of crop yields. This uncertainty makes it difficult for insurers to accurately assess risk and price crop insurance policies, leaving farmers vulnerable to financial ruin in the event of a disaster. The traditional insurance model, based on historical data and predictability, is struggling to keep pace with the rapid changes brought about by climate change. To remain viable, the industry must adapt, embracing new technologies and innovative approaches to risk assessment that account for the unpredictable nature of a changing climate. The insurance industry's exposure to climate risk extends far beyond its underwriting activities. As major institutional investors, insurers manage trillions of dollars in assets, and these portfolios are also vulnerable to the impacts of climate change. One of the most significant risks is the potential for stranded assets. Insurers have traditionally invested heavily in fossil fuel companies and other carbon-intensive industries. However, as the world transitions to a low-carbon economy, these investments could become increasingly risky. Government regulations, technological advancements, and shifting consumer preferences are all contributing to a decline in the value of fossil fuel assets. Climate change also poses physical risks to investment portfolios. Extreme weather events can damage infrastructure, disrupt supply chains, and lead to business interruptions, all of which can impact the financial performance of companies. Insurers with significant investments in vulnerable sectors such as real estate, agriculture, and tourism could face substantial losses. Moreover, climate change is a source of increasing market volatility. As investors become more aware of the financial risks associated with climate change, we can expect to see more frequent and dramatic swings in asset prices. This volatility can create challenges for insurers as they manage their portfolios and try to generate stable returns for their policyholders. The financial stakes of climate change for the insurance industry are high. By ignoring these risks, insurers are not only jeopardizing their own financial stability but also contributing to the systemic risks that climate change poses to the global economy. A proactive and forward-looking approach to investment management is essential to mitigate these risks and ensure the long-term viability of the industry. So, why do insurers hesitate when it comes to climate disclosures? Well, it's a complex issue. For one, there's the sheer uncertainty of predicting climate impacts. Insurers rely heavily on data, and when it comes to climate change, the data can be, well, quite variable. Another factor is the competitive landscape. Insurers worry that disclosing too much information could put them at a disadvantage. It's a bit of a balancing act, you see. They need to be transparent, but not so transparent that it hurts their business. And then there's the regulatory environment, which is still evolving. Insurers are often caught in a web of varying requirements, making it difficult to know exactly what to disclose and how. It's a challenging landscape to navigate for sure. So while the need for climate disclosures is clear, the path forward for insurers is, well, anything but straightforward. The insurance industry faces a trifecta of risks in the context of climate change. First, regulatory risks emerge as governments and international bodies tighten climate-related regulations. Non-compliance can lead to significant penalties and restrictions. Second, financial risks are evident as climate events become more frequent and severe, impacting asset values and increasing liabilities. Lastly, reputational risks are ever present. Stakeholders demand transparency and accountability, and failure to address climate risks can severely damage an insurer's reputation. Embracing the Task Force on Climate-Related Financial Disclosures, or TCFD, offers several strategic benefits. By adopting TCFD recommendations, insurers can enhance their risk management processes and improve their ability to anticipate and respond to climate-related risks. Additionally, transparency in climate disclosures can attract environmentally conscious investors, providing a competitive edge. Furthermore, insurers who lead in climate disclosures can set industry standards, positioning themselves as forward-thinking and responsible entities in the eyes of stakeholders. Implementing TCFD recommendations requires a comprehensive approach. Insurers need to integrate climate-related risks into their governance structures, ensuring that the board and senior management are actively involved. They must also assess and disclose the potential impacts of climate change on their business, using scenario analysis to understand different climate futures. Moreover, insurers should develop strategies to mitigate identified risks and capitalize on opportunities. This involves continuous monitoring and reporting, fostering a culture of transparency and accountability throughout the organization. The insurance industry stands at a pivotal moment. By leading in climate-related financial disclosures, insurers can play a crucial role in driving global efforts to combat climate change. This is not just a regulatory or financial imperative, but a moral one. Insurers have the expertise and resources to influence positive change, protecting communities and economies from the devastating impacts of climate change. It's time for the industry to rise to the challenge, setting an example for others to follow and securing a sustainable future for all.